Welcome, I'm Catherine Magana here with Greg Carroll, Steve Wolf, and Rachel Ivanovich, where we're here to provide you some insights about investing, the markets, and planning. So here we are a week later, and a lot's happened this last week. We've seen a pullback in the NASDAQ and some tech stocks. We've seen a rise in small caps, a rise in the Dow stocks. So it's kind of interesting. It's been a lot of movement in this last week. And obviously at some point we expected a little bit of a pullback with some of the tech sector, but it's still up year to date. But I don't think it was, it wasn't unexpected that we were going to see these kind of returns.
Yeah, and when you get a pullback in an entire sector, it doesn't mean that there's anything wrong with a particular stock. This sector has gotten extended. I'm not at all surprised that we are pulling back. Taking a little bit of profit is okay, but I wouldn't get out of all of your AI stocks. I think that would be a mistake. Of course, you should talk to your financial advisor and financial planner, whoever it is, to determine that. But generally speaking, when the whole sector is going down, don't look at any one company and say, well, that's the one that's bad.
Well, it's interesting, the small caps just this last week are up almost 9% as of yesterday's close. So that was a big move in a short period of time.
And small cap stocks have done very little in this time frame. It's been all large cap growth really for the last, 2 years or so?
At least. I think the dispersion between large cap and small cap got to a gap that's wider than it has maybe ever gotten. So you have a lot of resources probably shorting those stocks, hoping they stay down or go flat, and then everybody's going into the tech stocks. So once you reverse that, and there's big money in those tech stocks, a little bit of money going in that small cap space can really make the market move, as we saw just in less than 5 trading days. I think, we're up double digits. Yep. So.
And then it was interesting, I just came across that mortgage applications in the U.S. soared by 3.9% last week. So it's, as we're kind of talking real estate and seeing a little bit of a shift, we were just sharing that we've had a lot of client calls over the last several weeks and several months about real estate.
Absolutely. I've had multiple calls last, 3-4 weeks, people asking about, well, if I sell my house, what's the tax implication going to be? And I think there's a lot of misunderstanding when it comes to capital gains and the sale of a primary residence. And so the people want to know, so if I sell my house and I take the proceeds and I buy another house, do I have to pay tax on the capital gain? And I say, okay, time out. Mm-hmm. That's a rule that was from the 80s or maybe before, it was before I became a tax advisor. So that is not a thing. That is actually has to do with sales of business real estate. So we're talking about primary residences, and so if you sell your primary residence, there's something called Section 121 of the tax code that applies. And basically, if you sell your property, you can exclude up to $250,000 per spouse or individual living in that property. So we had a client who called in, and they are selling a property, and they're not married. They've owned the house together, they live in the house together, and they wanted to know, okay, what does the capital gain look like? They bought the house for $300,000, they're selling it for $1 million. They each file separate returns. Can they each take that $250,000 exclusion? The answer is yes. So that was one scenario where you've got a couple living in a home, not married. Then we had a couple who called. Well, actually, the wife called in. The husband had recently passed away in the current year, and so she really was concerned. They bought the house for $2 in the 60s, and now it's worth $1.5 million. Am I going to will I have to pay tax on all of that? And what does that look like? She was so relieved to hear that there are provisions in the code where actually she's going to have zero capital gains on the sale of this property. Number one, because her spouse passed away in the current year, which means they can file a joint return, and they will then get that $500,000 exclusion, the $250,000 for each spouse, and she gets a step up in basis, meaning what they bought the house for originally, it goes up to market value. So that reduces the capital gain as well.
So you're getting a lot of calls on selling their house. Is that specific to California because people are moving out of here?
That's a great question, Steve. So you do have to check with your state. California is infamous for not conforming with the federal government, but California does conform. So you definitely need to check in and find out, does my state conform? But pretty much across the board, I've never done a tax return where the state hasn't conformed to the federal rules.
Okay. Oh, you get an exclusion on the state tax as well.
Yes.
But my real question is not that. Although, thank you for saying that. That was a good question.
So your question
My
was...
question is it more, you're getting a lot of calls because people in California are thinking more about selling their house than else because they want to get out of the state of California, or is it coming from all over?
I think it's also been certain circumstances. One of the clients we were sharing, there was a couple, they weren't married, and the partner, he needs to go into a medical facility, and so there's some health concerns and things that were happening. So so he needs a little more care, and so it's just more, things that are coming up. And then the other client, her husband passed away, and so there's just unfortunately life events and things happen. And then looking at the plan and what's the tax consequences of some of the things that were.
I wonder too if people are kind of looking out into the future, thinking that taxes are not taxes, but interest rates are going to go down, and maybe they get down to mortgage rates of 5% or 4.5%, which makes buying another place more palatable.
Absolutely. We had another client. So to answer your question, this is somebody who didn't move out of California, but the mother, the elderly mother, had gotten ill, and they needed to move her to a facility as well. And so, of course, they were thinking, well, I'll put the house into an irrevocable trust. And this is a huge planning opportunity. And so definitely be calling and talking with us, calling your financial advisor before you make these moves. Call your tax person, because the family wanted to put the house into an irrevocable trust. And that's a huge, huge mistake. They'll lose that capital gain exclusion, because when they sell the property, they'll have to pay tax on all of the gain by putting it in the wrong sort of trust.
So it's it's funny because we had something recently that someone called us and wanted to know if the annuity that they just bought was a good idea without talking to us first. And when we went over it, I'll try to quote another financial advisor company. I would rather go to hell and burn than have an annuity. Now, I think that some annuities are okay, but this in particular was not a good one.
I think part of this was the information that was being shared. So I think their interpretation of this was that there's no fees and that they had access to certain investments and were getting, all the returns. And the reality is there either are some caps or participation rates, and there's a lot more.
Yeah, and the participation rate was like 57% of what the index was, and they thought they were getting the whole index.
So it gets confusing, and so if you're not educated and don't know,
right.
So and then we came in after the fact, and so and there is a look back in different states. Every state's a little different. It can be anywhere between 10 days or 30 days. But once again, if you already did it, it's hard to unwind versus, come talk to us before you do these types of things.
I think that's the point, is that especially with annuities. Annuities have a lot of different kinks to them, I'll say, that you really need to understand it before you go into it. So, like I said, we're not against all annuities, but many of them are kind of,
Well, the annuities are sold, as a very simple investment. You've got fixed annuities, immediate annuities, variable annuities, fixed index annuities, and some of those are sold with no fees, no downside. But once you really have to understand them well to understand how they work. I mean, these companies are not nonprofit companies. They make good money, and they make sure that they make good money for their shareholders. So you should always get a second opinion on any annuity just to make sure it's the right one for your situation.
Or even a first opinion.
Well, I think that wraps it up for this week. So at this point, unless there's anything else anybody else wants to add before we finish up today.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.